Hello everyone, it's Dale here, and in this video I'd like to talk about stop loss trading, and I'd like to give you some pointers and tips how to use it to maximize your gains. So by stop loss trading, what I mean is moving your stop loss in a direction of a trend in which you participate in. So let's say that you, for example, entered your trade in here, that you entered a short, and then as the downtrend progresses, you secure your trade by moving the stop loss, right? Moving it like this and securing your gains, right? So this is what I mean by trading stop loss. Now, obviously, it best works in scenarios like this, where the market moves one way without too huge pullbacks, and you can simply drive the trend and just move the stop loss, secure your trade, and get a huge profit out of it. Let me give you one more example of such a beautiful scenario of a nice trend where you can trade a stop loss. It is something like this. This is like an ideal case where you can trade your stop loss when there's a strong trend without huge pullbacks. That's the ideal scenario. But the problem with this is that this is rarely the case, because this is not how market usually looks like. This is not very typical. In fact, you won't really see a strong trend without any pullbacks like this one very often. What's way more common is market moving more like this. Not in a strong trend, but more sort of unpredictable ways, where there are those swift movements like those, market manipulations or stop loss runs, changes of volatility, and also changes between rotations and trends, right? The fact is, market is most of the time in a rotation. I would say like 70% of the time market is in a rotation, and only around 30% of the time it is in a trend. And trading your stop loss is only good when the market is trending. And as you can see, that doesn't happen too often, right? The market is shifting, market is changing, and it is very rarely moving just in one direction without huge pullbacks. And that makes taking those big trades with trading your stop loss quite difficult, but not impossible. And in this video, I'll show you how to go about this. Now, let me start with addressing one problem that I think many traders have. And the thing is that when they are trading their stop loss, they only move their stop loss, like for example in here, imagine there's this uptrend and you are in a long trade and you are trading your stop loss, moving it higher and higher. The problem that many traders have is that they don't have fixed take profit, and they only wait until the market kicks them out of their trade, right? After the trend reverses and kicks them out of their trade. But having market decide whether you quit your trade is not really a thing that I would advise you, because it should be you who decide when to quit a trade. Check this out. Imagine you are short from this place. You are trading your stop loss, and now there's this sudden reversal, kicking you out of your trade and taking back most of your profits which you took from this short trade. This is truly a pain, isn't it? But when you don't wait for the market to kick you out of your trade, but have a set and fixed take profit, then you can actually have way better profit than just waiting for the market to kick you out. In this case, I would use the volume profile like this, and heavy volumes represent a strong support and resistance zones, right? So we have a heavy volume zone here, and this could be the take profit. So instead of waiting for the market to kick you out, you trade your stop loss by securing your position more and more. But when the price reaches this place, you quit the trade. You don't wait for the market to turn and kick you out. All right, so my first advice would be that even if you are trading your stop loss and trying to get most of your trade, you still want to use a fixed take profit, a place where no matter what, you just quit your trade. Let me give you one more example here. Imagine you are short from here, that you entered a short position, and you are trailing your stop loss, and then price reaches this significant zone, which you can see on the volume profile here, this volume bump. It reaches this volume bump, which could prove to be a barrier, especially when the volumes are within such a strong rejection place like this. They could prove to be a strong barrier, right? And you want to quit your trade here. And that's why this should be the take profit, right? So yeah, you are trailing your position, you are securing it, but when it reaches this barrier, you don't really want to risk it, because there is a huge chance that the price will just turn and delete most of your profits, right? You don't want that. You want to quit the trade in here when the price reaches this barrier. I look for those using the volume profile. Usually heavy volumes prove to be a significant support and resistance zones. All right, so don't wait for the market to kick you out. Always have a set and fixed take profit. And when your trade reaches that, you just get out of the trade. Don't wait for the market to kick you out. Now, another thing I want to talk about is how big the stop loss should be. Like if you are trailing a stop loss, how wide that stop loss should be. Because there is always the question, like, should it be tight and secure your position as much as you can, or should the stop loss be wide and let the trade breathe, or something in between? Well, the thing with the tight stop loss is, let's for example take a look at this uptrend area, right? So let's say that you entered a long trade in here, you are long, and your stop loss is very tight. So as the price progresses upwards, you trail your stop loss like this, but the first little pullback kicks you out of your trade, right? This is the pullback, this is where you get kicked out of your trade. So this is if you use too tight stop loss, right? With this kind of stop loss, you won't really catch the big fish. Something like this, you never catch that, because every small pullback will kick you out of a trade. On the other hand, if you use wide stop loss, let's take a look at the same example. You entered a long trade here, the stop loss is here, then let's say you move it here, then maybe here. But what happens is when the price reverses, it takes a lot of your gains and you get stopped out. But before that, this is the whole profit which you missed, right? So too wide stop loss is also not very good. And the truth is, you'll always have the dilemma whether you should use wider stop loss or tighter stop loss or some balance between it. Maybe you'll try to optimize it somehow on some historical data. But the thing is that you'll always have trades where you would wish that your stop loss was wider, and you'll always have trades where you would wish that your stop loss was tighter. But don't despair. There's this one thing which you can do and which I'm going to show you. And the thing is that you base your stop loss on barriers, not on fixed number of pips, like 5 pip stop loss or 10 pip stop loss or 20 pip stop loss, but you base it on what's happening on the chart. You base it on barriers that the chart shows. Let me demonstrate this. If I draw the volume profile here over this uptrend area, then strong zones, strong barriers are those heavy volume zones, right? Those formed within the uptrend. And if you enter a long trade here, and if you trail your stop loss, then you should always place the stop loss behind those heavy volume barriers. So this should be the first stop loss. Then as the price moves upwards, then the second stop loss would be here, right? This is how you move it. Then the price moves higher again. Behind this heavy volume zone, there should be stop loss 3. Then the price moves higher again. Behind this heavy volume zone, there will be another stop loss 4, right? This is how you should trail your stop loss. Don't base it on a fixed amount of pips, because it will always be too wide or too tight. But in this case, this is a logical approach where you'll place your stop loss based on market volatility and based on volumes. And the reason why I'm placing the stop losses behind the volumes are that those volumes represent barriers, right? And the price shouldn't go past the barriers. If a price goes past a barrier, then there's no point in staying in that trade. But those barriers, you can look at them as if there were sort of a shield which protects you from the price going against you, right? If the price goes past that shield, past that barrier, then you should quit your trade. Now let me show you one more example here. And on this example, I'm going to demonstrate how you can trail your stop loss and also how you can determine where to take a profit. So imagine you went short from here. And now it's not really important the reason why. Just imagine you went short in here and that you want to trail your trade. Now the first thing is to determine the take profit. So let me use the volume profile here. And the take profit should definitely be based on those heavy volumes, because heavy volumes are a barrier, right? They could turn the price. So this is a barrier, and that's why it should be a place where you take a profit. Because eventually what could happen is price turning there and completely changing its direction. In here, it only changes direction for some time before continuing downwards, but this barrier is a very strong heavy volume barrier, and it could actually cause a complete reversal. So that's why you want to take your profit when the price reaches here, right? So that's the first step. You identify this barrier and have your take profit here. Now, the next thing is trailing your stop loss to secure your position. Now, let me use the volume profile here again and show you how the volumes were distributed here. So as the trade progresses, those heavy volume zones are places which act as barriers, and you should always place the stop loss behind them. So as the price goes downwards, those should be the areas for the stop losses, right? So the stop loss moves like that, always behind that heavy volume zone. And instead of waiting for the market to kick you out of your trade, you take your profit when it reaches this barrier, right? Based on those heavy volumes. And that's the whole trick. So there are two things. First thing is setting a fixed take profit based on barrier, ideally using volume profile. And the second thing is trailing your stop loss and always placing the stop loss behind heavy volume zone. Now let me show you on one more example, so this is crystal clear. So if you look at this chart, then imagine you went short from here. The reason doesn't really matter now. And the first thing is you identify the place to quit the trade. You identify the take profit. So you look at the volumes and how they were distributed before, and you look for significant volume clusters like this one. So this is a strong barrier, and you definitely want to quit your trade before the price reaches that barrier and reacts to it. Right, so that's the barrier. And after you've entered the trade here, you want to trail your stop loss. And again, you want to use the volume profile to look into that area which you are trading, and you want to place the stop loss always behind heavy volume zone. So as the trade progresses, those are the most important places on the volume profile, and you should use those to secure your position. So at first, this should be the stop loss 1. As the price progresses downwards, this should be the stop loss 2. Then this should be the stop loss 3. But, important thing, you don't wait for the market to kick you out of the trade because you have this fixed take profit, right? So you trail your position some more. This is stop loss 4. And then the price reaches the take profit, which is here. Alright, so this is the way how you actually are in control and you place your stop loss in logical places. And also the take profit is in a place that represents a barrier, and it is you who is in charge when you get out of the trade, not the market, right? So I hope you guys like this approach. I think it's way better than trading your stop loss by using fixed amount of pips. Also, I think it's way better than waiting for the market to kick you out by not having a fixed take profit. So I really think that you guys should give this a try, and I think that you'll definitely see an improvement in your trading. Now, if you guys are interested about learning more about volume profile trading, then head over to my website. It is at trader-dale.com, and if you click this button which says trading course and tools, then it will take you to this page where you can browse my trading education and trading indicators. Right here, this is the volume profile pack, which will teach you everything about trading with volume profile. Below that, there's the order flow pack, which will teach you everything about day trading with order flow. Both those packs will provide you with my custom-made indicators. Those are the volume profile indicators, order flow indicators, and VWAP indicators. You can also get both those packs at the bottom of the page together in one discounted bundle. And if you guys are interested in day trading with me and other prop firm funded traders every day, then go ahead and click this button here, which says FTA. It stands for Funded Trader Academy. And in here, there's a video where you can learn more about it. And if you are interested, you can book a call, and there we can determine whether or no this is the right thing for you. Alright, so that's about that. Thanks for watching this video, and I'll be looking forward to seeing you next time. And until then, happy trading.